At the time of recording, stock markets in the US are pretty much at all-time highs. And what can be confusing, I think, if we go back over the decades, the strength we see in markets when, for example, economic factors such as unemployment don't look too good. So I thought, let's take a look at the relationship between stock markets and unemployment data and see if we can use this to try and figure out major turning points in markets. I think the relationship between economic factors and stock markets can be confusing and quite often not make much sense. If we go back to April 2020, now I know 2020 was something of an odd year from an economic point of view because of the global spread of the coronavirus. But in April 2020, we had US unemployment was at its highest level, above 14%, since the Great Depression. Yet, of course, stock markets had made their low in the previous month and then continued to rally, even though this key economic figure looked gloomy. But it's not just contained to years that are out of the ordinary like 2020. We'll come back to this in the second part of the video, but this is where we've seen unemployment peak, unemployment be greater than 7%, going back more than 60 years, the red dots on this chart. And you can see that actually we see increasing stock markets pretty soon after unemployment has peaked. So I'll talk a bit now about the relationship between the broader market indices and this key unemployment data. Then we'll come back and look at things in more detail and see perhaps how we might want to use it in our trading or investing. Hello, I'm David Jones from Capital.com, and I thought this time round we'd do a slightly different video. We'd take a look at the link between unemployment and the stock market, because clearly a major factor, economic factor like unemployment, can give us insight into the health or otherwise of the economy, and you'd expect that to have a knock-on effect on the stock market. And it does, but perhaps not in the way you'd first think. So as usual in this video, I'll talk about the link between unemployment and the stock market, and we'll look at quite a few historical examples to try and give us some clues as to how we might be able to use this in our investing. As usual, if you're watching this and you haven't subscribed, if you could click on subscribe, it does help support the channel, and it means we can continue to push out hopefully lots of interesting videos in the months ahead. Right, let's get into it and let's have a look at the effect that unemployment has on the stock market. So if you were coming to this, I think, with no experience or no prior knowledge, you may assume, well, if we've got high unemployment, that means the economy isn't doing too well. So we'd expect the stock market to be underperforming and perhaps even falling. On the flip side, if we've got low unemployment, so lots of people are in work, you'd think that points to a strong economy and suggests the stock market should be doing well. That can sometimes be the case, but if we look at just the events from 2020, which was admittedly something of a one-off year because, of course, we had the coronavirus pandemic, we saw unemployment in the US in April of 2020 hit, in percentage terms, its worst levels since the Great Depression. So we had to go back to the 1930s to see unemployment as a percentage so high. It was above 14% in April 2020. But if we look at the stock market, what was the stock market doing in April? It wasn't falling. It had already hit its bottom in March and had rallied quite strongly into April. So even though we had that incredibly negative news about the economy, the stock market was already in recovery mode. As I said, it was a bit of a strange number because people who were unemployed, plenty of people were receiving furlough payments. They were being paid to stay at home because of the virus. Plus, of course, central banks around the world were stepping in to help prop up economies, keeping interest rates low. But actually, it's not as strange a connection as you may think. High unemployment, but still a rising stock market. And we'll explore this in a few other examples over the decades in a second. One important point to remember, the stock market is not the economy. So we need to remember when we're looking at either individual stocks or the broader market, whilst of course it's a reflection of perhaps investors' thoughts about the economy, the stock market is always looking forward. So one way of seeing stock market performance is as a leading indicator for what might happen with the economy. So if the economy isn't doing too well at the moment or has been through a rough patch, if stocks are rising, it's a suggestion that investors think that much better times are ahead. So for example, by the time unemployment is reaching, let's say, a record low or the lowest it's been in 30 years, the economy may already be on the turn, and that's being factored in what's going on with the stock market. So unemployment numbers can be really useful when we use them in conjunction with what's going on in the stock market to perhaps identify major turns for the economy and the fact that stock markets should continue higher, or also to perhaps be a bit concerned that we're getting to the end of a strong economic cycle. So as usual, to add a bit of color to all of this, let's jump on the platform and we're going to look at some historical charts of the stock market versus unemployment and something a bit more up to date as well. So as I said there, it's really important to understand that the stock market is forward looking. Just because everything looks perhaps gloomy today, that doesn't mean that the stock market hasn't already factored that in. That was clearly the case if we go back again to 2020, where we saw the stock market, represented here by the S&P 500 index, had bottomed in the third week of 2020. We had those terrible unemployment numbers in April, but the market had bounced back by about 20 to 30% by then. So this is the market being forward-looking. As I said, it isn't just limited to last year, to that 2020 year when we had all sorts of one-off events going on. Let's take a look at things from a historical perspective. I think the next two charts are going to perfectly illustrate how forward-looking the stock market is. We looked at this one briefly. So this is, you can see the source at the bottom of the chart. It's based off US unemployment numbers, the percentage of the workforce unemployed, and it's picking up where unemployment peaked past 7%. So if we go back in history, you can see the red dots on the chart are highlighting these peaks in unemployment. So statistically, where unemployment was high. But you can see we don't have major market tops, and we may have perhaps a slight wobble for stock markets in only a couple of instances, and they look to be very small wobbles when we're looking at the market here on a log scale to see the percentage change. But you can see how forward-looking the stock market is. So even if unemployment looks really bad, the market has probably already factored that in. So by the time unemployment is reaching this major historical high for the percentage of people unemployed, the argument is, well, perhaps the economy is already recovering. The economy is already on the turn. And the flip side of that is where unemployment goes to be less than 5%. So we have unemployment at a historically low level. I don't think the correlation is quite as complete here. But if we look back in some of the recent history, or not so recent, going back 30, 40 years or so, we can see it here ahead of the financial crisis. And again, here, that was the end of the dot-com bubble. And again, back here in the 1970s. So we can see where unemployment looks really low. Clearly, the economy is doing really well for unemployment to have got that low. But because stock markets are forward-looking, perhaps they've already priced in all this great economic growth, and it does leave the stock market a bit more vulnerable. And I don't think we can have a video on unemployment and the stock market without talking about the non-farm payrolls. So this is US unemployment data. It's released typically on the first Friday of every month. Occasionally it slips to the second if the previous month was a short one. Just to show you how we can get sometimes quite a big jump in volatility. This is at the time of recording, the latest unemployment data release. So it gets released an hour ahead of the US market's official open. The time here on mine is UK time. So the number comes out at 1:30. In this example, in July 2021, the numbers for June came in better than expected. The market was expecting something like 700,000 jobs to have been added in the US economy. The number came out and it was actually 850,000 jobs. So a good number, suggesting perhaps even a stronger economy than many were expecting. As we can often see, there's often a bit of a strange move on the number. Initially, the market sold off, but you can see over the course of the next half an hour or so, these are 1 minute candles, we did see the market react positively, which is what you'd expect. That's not often the case. Sometimes we can see the market turn the other way in response to a good number. But for those of you who want to watch the effect of unemployment data on the market, keep an eye on those non-farm payrolls normally released the first Friday of the month. That's the end of our look at the connection between stock market and unemployment. There is a connection. It's perhaps not what you first thought it might be. I hope you found it useful. We'll leave things there. So from me, David Jones and Capital.com, good luck with your investing. For more trading videos just like this, please subscribe to our channel.